Trump said World War III is near. Poland wants to acquire nuclear weapons and double the size of its army. In Spain, demand for underground bunkers has surged by 90%, and there's already a waiting list. They're even handing out flyers about food storage. The truth is, World War III might actually be closer than we think, and you need to know how to handle your money in times like this. That's why I decided to make this video, breaking it down into two main parts. First, I'll briefly explain what's going on with this whole conflict. Then, I'll show you how to protect your finances in case of a possible war. But before we get started, don't forget to like and subscribe. First part, what's happening? To explain what's going on right now between the United States, Russia, Ukraine, and Europe, we need to go back a few years. A few decades ago, the world was caught up in what became known as the Cold War. Then, in 1989, the Berlin Wall fell, marking the collapse of the communist side of Europe and symbolically signaling the end of the conflict. However, the official end of the Soviet Union only happened 2 years later, in 1991. That same year, Ukraine declared its independence from the Soviet Union and has since been trying to align itself with NATO, North Atlantic Treaty Organization. And they've tried multiple times. In 1994, they signed an agreement with NATO, but membership didn't happen. In 2002, tried again and failed. In 2008, 2010, 2017, 2019, and 21, more attempts, all unsuccessful. When it finally seemed like Ukraine was about to join NATO, Russia invaded the country. It was 3 years ago. And despite all these efforts, Ukraine still hasn't been able to join NATO due to the ongoing conflict with Russia. But wait, why does Ukraine want to join NATO? The reason is simple. If Ukraine were a NATO member, it would automatically receive military protection from the alliance, thanks to Article 5 of the NATO Treaty, which states that an attack on one member is considered an attack on all. In other words, if Ukraine had already been part of NATO when Russia invaded, all NATO countries, including the US and Europe, would have been obligated to join the war to defend Ukraine. And that's exactly why Russia never wanted Ukraine to become a NATO member. Since Ukraine isn't officially in NATO, no country is required to defend it directly. This explains why, while the US and Europe continue sending weapons, money, and imposing sanctions on Russia, they haven't officially entered the war. But this conflict is just one piece of a bigger global tension since Trump took office as President of the United States and since he has increased import tariffs on several countries. For example, before this, an imported car from Mexico used to cost $30,000 in the US. With a 25% tariff, that same car now costs $37.5K. According to Trump, the goal is to protect American industries and reduce the trade deficit with these countries. His administration wants companies to manufacture more in the US and less overseas. But this also has side effects. Higher prices for American consumers. And what happens when a country imposes tariffs? The other country retaliates. Canada has already announced tariffs on US products. Mexico is considering countermeasures. China has said it will take the issue to the World Trade Organization. And this trade war is happening at a delicate moment because even in the US, market is showing signs of concern under Trump's leadership. Just to give you an idea, the S&P 500 erased all gains since Trump was elected. Inflation remains high in the US, unemployment is rising as the government tries to reduce payroll expenses, economic growth is slowing down, and for the first time since 2022, a majority of investors believe stock prices will fall in the next 6 months, according to American Association of Individuals Investors. Less than 20% expect stock prices to rise. And amid all this, there's a curious shift happening. The US is getting closer to Russia. Trump pressured Zelensky to make a deal with Putin and end the war. war, but Zelensky refused. Tensions escalated. Trump even suggested that if Zelensky doesn't make a deal, the US might cut military and financial support for Ukraine. The result? Ukraine is now more isolated than ever. Europe is worried, and it looks like the US will continue moving closer to Russia to weaken its biggest commercial and military rival, China. So this is the whole current scenario. A massive trade war between the US and the rest of the world, China expanding its military and imposing tariffs on US products, Europe increasing internal weapons production, fearing a world war, Ukraine gradually losing US support, Trump aligning more closely with Russia. The pieces are in place. The game is already underway, and unfortunately, the latest news suggests that things could get worse. Obviously, we can't just focus on the bad news. News outlets thrive on selling fear and chaos, but we must prepare for the worst always. That's why I need to share what I believe you should do to protect your wealth in uncertain times like this. Let's move to the second part. What to do with your money. What I'm about to show you is a set of data spanning over 150 years of history. There are three economists, Oscar Jorda, Federal Reserve Bank of San Francisco, Moritz Schularik, Kiel Institute, and Alan Taylor, Columbia University, who dedicated their entire careers to compiling historical financial data from multiple countries. They spent decades consulting books, analyzing government documents, and even speaking directly with central banks worldwide to put together this study. So it's only fair to credit them for collecting data from 18 different countries, which I'm about to show you. What I did was compile everything into an Excel sheet and pull the numbers specifically for the United States. Looking at the numbers from World War I, the top performing asset was real estate, which means properties. In World War II, the winner was stocks, but almost tied with real estate. And during the Cold War, stocks were the best performing asset. In the Gulf War, the best asset class was real estate. During the 2008 crisis, gold was the top performer. And during COVID-19, stocks were the best asset. So looking at the 6 biggest wars and crises of the last 100 years, stocks were the best asset class, winning 3 times. Real estate came in second place, appearing 2 times. And gold was the best performing asset only once, most recently in the 2008 crisis. There are 3 key takeaways we can draw from this. First, bonds, which is fixed income, do not appear as the winner in any war. But without having cash in your portfolio, you would probably panic, sell stocks at a loss, and miss out on the opportunities the market would present. It wasn't the winning asset, but always have cash on your hand. Second, until 1971, gold has its price fixed by the US government, so it couldn't outperform bonds, stocks, or anything else. But gold is well known as a crisis hedge. If you look at a 2008 crisis, while stocks dropped 8% and real estate returned only 1%, gold surged over 11% per year. So having a portion of your portfolio in gold during major crises can also make sense. And third, it's not enough to just look at what happened during the war. We need to look at what happened after the war. For example, 1 year after each major war, stocks won 4 times, real estate once, gold once. 3 years later, stocks appeared 2 times, real estate 2 times, and bonds once in the 2008 crisis. 5 years later, stocks won 3 times, real estate won 2 times, and 10 years later, stocks won in all wars and crises. So another key takeaway is that over longer time frames, it's very hard for any other asset to outperform stocks. That means if you have cash to invest during a major crisis and a little patience, the best thing you can do is accumulate stocks. Now, in shorter time frames, when analyzing 3 or 5 years after war, real estate tends to tie with stocks. So the structural allocation you need to follow is more or less like this. Before a war, you need to have 40% of your wealth in cash. You decide how to split it, but this can be divided into bonds, savings accounts, or any other safe investment where you can access your money at any time. 30% invested in stocks, 10% in international assets, and 15% in real estate or property assets. And here I'm talking about physical properties and REITs. The ideal scenario is to invest in good real estate deals, but I know that this requires significant capital and is usually for those with more money already invested. So you can opt for REITs or slightly reduce this portion of your portfolio and allocate more to stocks. Do as you prefer. And maybe 5% in gold. And why this portfolio allocation could be the best? Cash gives you liquidity to rebalance when prices drop, meaning you can buy stocks and take advantage of opportunities. 30% in stocks because they will rise even more 1 year after the war. It doesn't make sense to go all in now. You need to buy gradually. International assets make up the portion of your portfolio outside the US. Since we're talking about war, you need protection against local risks. Real estate also follows the principle of always being above personal opinions, and I would rarely sell my entire position. I believe everyone should invest in land because God isn't making any more of it. 5% in gold because in the last major global economic crisis, which was in 2008, gold was by far the best investment. And depending on your investment philosophy, when I say gold, you can split this portion with Bitcoin, which is essentially modern gold. And if you think it's excessive to have almost half of your wealth in cash, even Warren Buffett, the greatest investor of all time, who has always had most of his wealth in stocks, is currently holding record levels of cash in Berkshire Hathaway. Berkshire's cash reserves are now at $125 billion. Not to mention that Buffett sold part of Apple and Bank of America. So this is the structure you need to have. During the war, your allocation will change and look like this. 10% in cash. You use the cash I just mentioned to rebalance your portfolio. 10% invested in international assets, always diversifying to protect against local risk. 45% in local stocks. Historically, this has been the asset that gained the most during wars. 25% in real estate, the second best performing asset, sometimes timed with stocks, and 10% in gold because it's a crisis hedge and was the best performing asset in the last major crisis. And post-war, your allocation will change completely as well. Over 5-year windows, stocks won 3 times and real estate won twice. Over 10-year windows, stocks won in all wars and crises. So your allocation should be close to this: 10% in cash, 10% invested in international assets, 50% in stocks, 28% in real estate, and 2% in gold, or Bitcoin, as I just said previously. Guys, this is how you protect your wealth from war, allocating your wealth within these 5 asset classes and adjusting your portfolio as the situation evolves. And I know this is a turbulent period. This crisis can escalate quickly, and my contribution here is to help you from the financial side because I don't just want you to protect yourself, I also want you to make money during these conflicts. Anyway, that's it for now. Bye and see you next time.